Hi, I'm Dr. Kevin Milo, and you're listening to the Physician Empowerment Podcast. At Physician Empowerment, we're focused on transforming the lives of Canadian physicians through education and finance, practice transformation, wellness, and leadership. After you've listened to today's episode, I encourage you to visit us at phys-empowerment.ca, that's PHYS, empowerment.ca, to learn more about the many resources we have to help you make that change in your own life, practice, and personal finances. Now on to today's episode.
All right. Okay. So welcome everyone to this very interesting episode about the hidden power of insurance in tax planning. So I'm really excited to have Angela Lang to be with us as our guest. And yeah, so Angela, thank you for saying yes to our invite. So Angela and her husband, Ernest, my wife, Kitty, and I, we just spent a wonderful weekend, a few weeks ago, a month ago, maybe?
Yeah, a few weeks, yeah.
In Vancouver. We spent some time in Victoria as well, looking at some real estate. And then we actually went to a forum. I was invited by Angela and Ernest to listen to the chief economist, right? That was Monday afternoon, room packed with people. I had a blast. I always love economist talks. And then Angela is an accountant, and then she's also doing insurance. We'll dive into that. But she's also a DK. She's a doctor's kid. So her dad has been a family physician for a long time, decades, right? Finally retired at the age of
his early 80s.
Early 80s. True blue, right? And so now we call IMG, right? International Medical Graduate, right? Like he was from UK. And so we kind of, our kids are DKs, right? And there's always this, you're a doctor's kid, ... So one anecdote from our kids is, we were at medical conference. Our daughter was like 8 or 10. She was drawing hands. She's really good at that. And then she's drawing the swan lake neck deformity of rheumatoid arthritis. So, so that's like a DK.
I always joke that I have a cast iron stomach. We talked about everything at the dinner table. We looked at pictures of medical textbooks because, of course, not only was my dad an emerge doctor before he was in family practice, my mom was a renal nurse as well. Oh, so I can talk about anything at the dinner table. There's no boundaries.
Yes, no boundaries, right? So yeah, so this is all cool, all cool. And of course, it does irreversible damage, according to our kids, right? And none of our kids want to be doctor. One time, my middle kid, they say, "Dad, let's do some math." I said, "I would always love to do math with you, kid." And we sat down and we worked out my loss of sleep. And at that time, it was actually 4 years that I lost sleep. Anyways, okay, so we'll dive into this, Angela. So how did you switch from being an accountant to going into insurance? How did that path start?
That's a great question. Actually, I like to blame this one on my husband, Ernest, who is a serial business starter and entrepreneur, but he has so many interests that he can't kind of sustain them all. So, when I actually did my accounting designation later after having kids and was working at a small firm. And he actually, so Ernest actually started Promerita in 2007. And as I was finishing my designation and just trying to figure out how to juggle everything, do I stay in public practice hard with a young family? Do I look at industry? He said, come, let's test this out. Insurance is actually a pretty great business. It definitely makes sense if you've got an accounting background. And I think you'll work well with professionals. And so I kind of slowly got involved in that and didn't really look back. It actually was a great fit for our family.
So fast forward, you were speaking to the STEP just a month ago, right? Society of Trust
and Estate Practitioners in Canada.
Right, so TEPs, right? The TEPs and this society, and you were one of the speakers. So congratulations again.
Thank you.
So it's a very prestigious room, right? So what were you advising these TEPs?
Sure. So I was fortunate actually to be invited to be co-presenter with Florence Marino. She used to be the head of tax and estate planning at Manulife. She's actually recently retired from Manulife and works kind of with a firm in Ontario. And I was speaking as well with Hemel Belsara, who's now the current head of tax and estate planning with Manulife. And so we actually had a seminar. It was a breakout session called Life Insurance Planning, the Intricacies That You Need to Know. And we were covering, frankly, in 90 minutes, everything from product, the difference between universal life and whole life, as well as strategies, talking about pipeline planning, talking about leverage using life insurance, where it's appropriate, where it's going too far, and even touching on life insurance in charitable giving strategies. And we basically had to, it was a lot of information in a 90-minute time frame.
Right. Yeah. So let's go back a little bit for our audience. Lots
Sure.
of people listening. And so to most people, insurance is playing defense, right? It's just in case you get something for the family, right? So very few people think about that as like an offense, right? Like a part of a playbook of a game to actually do actual tax planning, right? And a buddy of mine, he's one of our faculty members, Jason, right? He says in the Canada tax code is like a big thick phone book, right? And there's a huge chunk of that is actually on insurance. And interestingly, people in the insurance industry, they don't study that. Interesting, people who are tax lawyers don't, and tax accountants may not even study that. They do, they have to, right? But there's a big chunk of that, right? It's just like I tell people, it's like the phone, right? When we had a phone, the phone was just for one thing, to call people. But nowadays with the smartphones, people, do anything, like our kids, anything but call people, right? And so how is Digest, how and why would CRA allow insurance as a part of tax planning?
If you don't mind, I'm going to just jump back a bit on the defense just for a minute, just to kind of put it in the greater context, if that's okay, because I agree. Most people think of insurance as protection. It's kind of that risk mitigation. You're, transferring financial risk to a third party, an insurance company. I would say from the perspective of doctors, that's going to, when they're young, especially like disability, as well as critical illness insurance are really both types of protection, as well as things like term insurance that's going to help cover income protection, mortgage risk, etc. So just to put it in that context, but then really when you're talking about offense, that forward-looking insurance, when you're talking about permanent insurance, and that can involve either universal life or whole life, and there's some real structural differences between those products and where it can make sense to use them, but they're both, permanent insurance strategies. Really, there's some real tax advantages that are enshrined within the Income Tax Act, as you've alluded to. And if you look at permanent insurance, so most products in Canada are something called an exempt life insurance product. And an exempt life insurance product means that it is staying kind of within the exempt test policies, and any investment growth in the insurance policy is actually not subject to annual accrual taxation. So as long as a policy, which gets tested by the insurance companies in a variety of ways, there's like the 250% rule, there's a whole bunch of tests that are done annually by the insurance companies. As long as the cash in the policy stays below a certain line called your MTAR line, your maximum taxation actuarial reserve, it's considered an insurance policy and not an investment. And so most exempt policies in Canada that are, stay within those rules and are considered an insurance policy, any growth in the policy is not subject to annual taxes. So that's one real advantage. But a couple other advantages when you think about it, let's say you're buying an insurance policy, it's going to be for $1 million, it's permanent insurance, you're paying a certain premium over 10 years. After you make that first payment, after day one, you've actually got immediate protection for the full amount of risk. And in fact, that's actually the most, from a tax efficient perspective, that's the best time to die from an IRR on that policy, because your return is going to be fantastic. So you're getting immediate protection, even though you've only put down a portion, one premium payment, let's say out of 10. So you've got immediate protection. You've got growth that's happening tax-free within the policy. And then when you've got a policy, so if a policy is owned by a corporation, let's say you were talking with physicians here, so they've got their professional corporations. When something happens to the insured, the doctor, the corporation owns the policy, and the corporation should also be the beneficiary of the policy. Okay, that's an important piece here, in that you don't want to name like a spouse or a child as a beneficiary of a corporate policy. That can actually result in a taxable shareholder benefit. So that the corporation is the beneficiary, but when the insured dies, the insurance benefit is received by the corporation tax-free. And it also, that receipt of the insurance proceeds in Canada creates a notional capital dividends account. That CDA is so valuable. And it's that CDA that can be paid out of the corporation tax-free using tax-free capital dividends. And so
let me stop you there. Sure. I think it's let's backtrack a little bit, because there are two camps, right? There are two camps. Yep. There's a very large camp, and when my wife went to finance school way back, the first edition of Wealthy Barber was written. Right? That's how long ago it was. No, the second edition. And there's a rhetoric, forget about all these, just buy personal term life. Right. And so forget about all these corporately owned fancy whole life and all that. So can you explain why there are two camps, and why some people are so bent on term life because it's cheap, and why they say that you should buy whole life, universal, all those?
We would say we always have to be careful with all of these fintech influencers online, because they're often speaking to general scenarios and not a particular individual scenario. So I agree, some of the discussion out there is very much, we should never look at permanent insurance. Let's only look at term. It's cheaper. And there's an element of that. You could take those additional funds that you're not spending and invest them. And over time, they're going to grow. I would want to see, though, a proper comparison because it's different when you've got funds that are trapped in a corporation, and particularly like professional corporations for physicians are often trapping excess surplus. Unless a physician is spending everything that they make, they're taxed at a lower rate in their corporation, up to $500,000. Any investments they make within their corporation, once they start to get more than $50,000 in passive income, that can start to grind down the small business deduction. And so oftentimes these analyses are very simplified, right? But if you've got a professional corporation where you've got trapped surplus, and you've got this ability, if you don't need all of the assets during your life, and some of your intention is to pass it in a tax efficient way to your children, oftentimes these analyses are not actually looking at the full taxable implications of that. And so you do have to be careful. I also think there's an element in many of these videos where they need to have kind of extreme reactions in order to garner the views, right? It makes it more exciting.
Yeah, I'm very familiar with that. The logistics, right? How they create. Right. So the more controversial they are, the more views they create.
So there are scenarios, don't get me wrong. There are scenarios. If somebody doesn't have the cash flow, there are definitely scenarios where people should only have term insurance, and they may not have a need for permanent whole life insurance. On the other hand, oftentimes for business owners that are making more money than they're spending, that are trapped within a corporation where they're looking for alternate investments that are not increasing, their aggregate alternate investment income, or they're looking to transfer something tax efficiently to their kids after they pass. Permanent whole life insurance can be a fantastic and tax efficient way to do that. So it's like anything. The product itself is good, but it has to be used appropriately.
Right, exactly. So there's, like I said, there are two camps in our space, right? There are a lot of influencers, like you say, right? And a lot of them are actually medical professionals like ourselves, right? Like, peer to peer. And there's big, huge camp about ditch those people, whole life and all that, just do the term life personally owned. But then there's no shortage of salespeople out there putting a lot of videos, LinkedIn, and there are a lot of terms, and we may as well throw some terms out, right? Infinite banking concept.
Yeah.
My own previous life insurance agent just ditched everything else he did. He just did IBC, and he said, I wrote a book, right? And
Really?
that's all he did. Yeah, that's all he did,
Yeah.
right? And there's a lot more on IFA, right?
Yeah.
Immediate financing arrangement. There's a name, retire something. And then there's split dollar, right? There's a lot of stuff there, and they were promising people a lot. And
Yeah.
we definitely have met colleagues because of our network that taken out these corporately owned policies that instantly loan themselves a ton of money and bought like a $5 million house or something, Yeah. And I know you're shaking your head. I'm shaking my head. I know enough to be dangerous, right? There's a whole bunch of tax implications, but there's so much bad blood out there. So I like you to help us walk through the good and the bad and the ugly.
For sure. And you've thrown out a lot of things there, Wing, that frankly, we could actually take them all separately, unpick them. I guess first and foremost, I want to say insurance is a risk mitigation tool. It's supposed to take risk off the table. It's not supposed to add tax or other kinds of GAR risks, or, it's if it's done proper. But when something sounds too good to be true, it often is. And I will
Can you
say,
explain what is GAR for our audience? The GAR risk.
Sorry, GAR is, oh gosh, I'm blanking right now. GAR risk is CRA term. Sorry, give me 1 second here. It's basically it's when they haven't got a risk. If it's not covered in the Income Tax Act, it basically says if we think you're doing something inappropriate with it, you likely are.
So even though you thought you're outsmart the CRA, you will not, right? They'll find a way to come back and audit you and guard it back.
Tax you. Yeah.
And tax
you.
And this, right?
Yeah, it's general anti-avoidance rule, basically. Right. Yeah. And so, and that's a big one, but because that's a more recent, it's almost like the big hammer in the CRA's back pocket, because it's not something that's defined, but it's always there. Maybe they'll use it. And so, okay, so you've mentioned IFAs, you've mentioned infinite banking, you've mentioned split dollar life insurance, and these are all things I could speak to. I'll touch on them briefly, and then, if you want to ask me more, let's go ahead. So immediate financing arrangements or leverage using life insurance. At the end of the day, I actually have a policy on myself and Ernest, owned by our corporation. In and of itself, it's not problematic. If you're putting insurance in place for the right reason, you have an insurable need, you have a tax liability. So, something we haven't spoken with here, but, often as business owners, we've got assets in our corporation, there's going to be real estate, there's going to be investments. If something happens to Ernest or something happens to myself, generally, we can do a tax-free spousal rollover and transfer assets together such that there are no taxes owing. However, it's really upon the passing of both of us, when assets remain transferred to our kids, that we're going to have some real taxes owing and some deemed dispositions. Even the real estate that it hasn't been sold, but the CRA is going to treat it like it's been sold, and there can be significant taxes, particularly, on real estate for people who bought at a low-cost basis. Right. So insurance is often very valuable, and frankly, if you've got a whole life or even a universal life policy that has a significant cash value, you can take that policy to the bank, and they'll use it as collateral to provide a line of credit. in and of itself, there's no problem with that. But an IFA tends to be like immediate financing on a new policy that doesn't have cash value quite yet. It takes usually, I would say, about 7 or 8 years for a policy to have the premiums that you put into the policy match the cash value of the policy. And if you've invested in a whole life policy, usually after about 7 or 8 years, the cash value is actually growing faster than the money that you put in. So there's a collateral, there's often an additional collateral need in the short term for the first 7 or 8 years until you've hit that point. But what we're seeing and what we're hearing is that this is a strategy that makes sense if you're comfortable with leverage, if you've got something else that you can use the money for. And I would say, if this is a corporately owned policy, ideally something else that the corporation can use that money for. We'll get back to personal borrowing in a second, where, either it's reinvesting in the business or some other type of investment that's going to generate a return greater than the interest that you're paying on the loan. And so, like in our situation, we've set it up. We generally don't use it. If an opportunity comes along, we can draw on it within a day by reaching out to our banker, but it would be for something where we're going to generate interest more than what we're paying. And then we repay it off and it's there. So it's like very quick liquidity when you need it. It should not be used to sell additional insurance because you actually need a minimum. So certain banks, you need a minimum annual premium of $100,000 for 10 years in order to even qualify for financing. Most financial institutions, though, require a minimum annual premium of $250,000 to $300,000 a year for 10 years. So sometimes what's happening is maybe somebody doesn't need quite that much insurance, but they're being sold a bigger premium with the understanding that they're going to get financing from the bank.
Right. So they got outsold.
Yeah. And you talk to most of the big insurance companies, like clients need to be able to afford these policies without the financing. If they can't afford the policy, that should be a bit of a red flag. If they need the loan in order to pay for it, that's backwards. And they actually technically are not supposed to be using the money that they borrow to pay for the premium.
Right. So that's now, so for a lot of listeners, this is really, really news, right? And I think we want to just dive in that for a few seconds because there are a lot of people targeting physicians and high net worth professionals on this, right? So, and we've got cases that we have helped people extricate themselves, and that's why I think it would do our audience justice to name a few of these names, and they're not bad by themselves, but there's definitely room for misuse or overuse or abuse, right?
I mean, not everybody is comfortable with leverage, right? It's one thing when, a couple years ago, interest rates were very low. You saw too much of this, premium financing being discussed, too many things. So, insurance being sold requiring, the financing piece. And then all of a sudden interest rates started to move up. And I started hearing more stories where, it's in those situations that they've been inappropriately sold. That's the problem, obviously.
So how about just for one more nail for the coffin for overusing, abusing these? When a person gets scarred by CRA, what happens when they got the anti-avoidance judgment?
Well, it really depends on the facts and the situation. I mean, there was something, some of your clients may have heard of something called a 10-8, which would have been probably, this was closer to about 2012. And it was a tied product that some of the banks were selling where you would buy insurance and you would get the financing, but it was linked. You couldn't get one without the other. And actually the rates that were set in terms of the interest that you were paying, and what you were receiving it was all intermingled and tied. And frankly, at the time, so I was just newer to the business at that point in time, but our firm actually, sent a letter to all of the accountants, the lawyers that we were working with, as well as clients, and said, stay away from this. This is trouble. It will be a problem. The CRA will flag this. And within a couple of years, they did. And actually, those any of those 10(8) policies that were sold had to be unwound. And actually, the consequences are still being played out today. I was chatting with an advisor recently where the CRA is still going back. And even if the structure has been unwound, they're going back and challenging the interest deductions. And actually, clients are having to pay more tax, or the CRA, they're still kind of playing their way through. So we haven't seen how they've all played out yet. But that's the CRA has challenged them on the interest deductibility side. So there could be then taxes owing as well as interest, et cetera. I mean, there's all kinds of ways. It's not even always GAR. Like some of the challenges that can arise are, simple. Like they just might be something, deemed to be a shareholder benefit. You make a mistake. Your insurance advisor makes a mistake. You've got a corporately owned policy. And instead of listing the corporation as the beneficiary and having the insurance proceeds flow through the corporation and then out to the shareholders, they say, oh, maybe it's faster to have the money flow directly to your child. That is going to be identified as a taxable shareholder benefit. And then, where those monies would have transferred to the children tax-free, they're going to be paying taxes on that as defined by Section 15(1), I think, of the Income Tax Act. Like there's all these little nuances. So it's not even always GAR. Sometimes there are other sections that things can be caught at. Yeah.
Yeah. So I guess the take-home message, right, is A, don't just buy in because people sell you that appealing benefit. And number two, even for a lot of these, the structure has to be correct.
Yeah.
Right? The accounting side, the legal side, both of them have to be correct.
And so ideally, we always recommend, like if a physician is actually looking at putting one of these structures in place, the insurance advisor that they're talking to should also be able to have a conversation with their accountant and or their lawyer, just to make sure that everybody's on the same page, things have been structured appropriately, that it's the right amount that they're going to be able to afford to pay, et cetera. And just make sure that, everybody's got eyes on it.
Yeah, and that's the whole point that we started this podcast, right? We offer peer-to-peer empowerment, and we're here not to give everybody answers, but to empower people to ask smarter questions, right, to the advisors. And sometimes the advisors don't talk, and unfortunately, that's more true than not true, right? Advisors from different facets, the team, different parts of the team do not necessarily talk. Maybe they don't find a reason. Maybe there's no common platform other than the busy professionals who haven't got time, right? And that's how people got trapped. So let's do the more positive side before we end the episode. So how do we do this right? How do we actually benefit from it without being guarded or get other unhappy consequences from CRA?
So much here. So I guess this is the challenge is there can be a lot. Insurance can be very technical, and it does require like some education, right? So the better you're educated, and if you're working with an advisor, you want to find somebody that you trust, you think you've got some kind of values alignment with, you've heard good things word of mouth, but where you know that you can actually ask questions and get them answered to whatever level you want them answered. I don't know. For me, a red flag is always feeling like that you have to do something or you have to do something quickly. If you've got any spidey senses that are going off to say, hey, I don't quite understand what I'm getting involved in. For me, that's, as the client, you need to be asking more questions, because at the end of the day, you're going to be the one that's getting involved in this structure, and any risk is ultimately going to end up on you. So if you don't understand it, you need to find an advisor that you can kind of get the answers that you need.
Mm-hmm. So then how would you advise a busy practitioner or a business owner? What would you advise? Let's say they're starting to accumulate wealth, right? We have 3 phases: early phase, what we call first 5 years in my language, right? And then with the middle, maybe in the next 10, 15 years, and then the 20 plus years all the way to retirement, where people tend to pay off debt, pay off mortgage, or a combination, at least got of a student debt. They start to accumulate wealth. They think about the next generation, think about retirement, posterity, right? So what would you advise those people? How should they do it? And so that purposely they end up strong, right? They finish well.
And you're talking about just in the third category there?
Second and third, yes.
Second and third. Well, I mean, part of what some of the discussions that we're always having with our clients is it's not always just about insurance. It's actually trying to facilitate some of those discussions and or find out like where there may be gaps. So even if it's not something that we do, I mean, it sometimes surprises me the number of times I'll chat with a client. They're talking about insurance, they're covering risk, they're looking ahead, they're even putting in permanent insurance. And maybe they actually haven't got their wills in place, or they did, but it was so long ago and their life situation has changed that they need to actually be, kind of bringing them up to date, let's say. And oftentimes through some of that process, the needs for insurance, or frankly, it's not just insurance, but it's how do we, as they're starting to accumulate assets, what are taxes payable looking like? Are there strategies that can be put in place to reduce that? What are their intentions around charitable giving? And is there a way that that's going to factor into the plan? And then insurance is just part of that discussion. Yeah.
Yeah.
And honestly, charitable giving and charitable giving with insurance can be a whole hour talk in and of itself. But it's really having the conversation to understand what is the client's goals, what are they hoping to achieve, how are they looking to kind of leave their legacy and for the next generation, what's important to them, and then how do we work with their other professionals to make sure that they are achieving what they want to achieve.
Right up. Well, thank you, Angela. There's a lot to chew here, and our time is up already so fast, or half an hour. Just boom, like that. But there's a lot here for everybody to just chew on, think about, and talk to your own advisors, right? And I can guarantee you that I talk to 90% of my colleagues in this space. Most people don't know what policy they got. Right? It's not
uncommon. Yeah.
Yeah, right. And so not to mention to time with the estate planning, start with the end in mind, looking at the whole situation, the tax planning, everything. It should be a conversation. It's like going to an orchestra and you see them play violin, trombone, drums, and there's no conductor, right? Like it's not going to be a nice concert. But unfortunately, that's how we do life, because we're too busy being what we are trained for, right? A clinician or business owner or whatever, right? And so that's why we want to bring this to everybody's prefrontal cortex. They can digest that and then ask some other questions. And we'll definitely ask you to come back, Angela, if you be so kind. And sure. I'm sure there's a lot to unpack, but like our audience to systematically just chew it off a little bit at a time. Right, sometimes just by repeating the names and the concept. And some people heard these names, they never understood what they meant. Some of them signed up for it. They didn't even know where they signed up. And whether they actually at risk of a GAR or whatever, right? They don't even know, or they have done one of those other policies that could be beefed up, right? To a very powerful tax planning tool.
Yeah.
Yeah. Okay, so I want to thank you again, Angela, for dialing in with us. What would be the one sentence you want to tell our audience before you go? Something burning message.
I think, as we've talked about, how do you, find the right product? How do you know that you're buying the right thing? I guess what I just want to say is insurance in and of itself is great, but, think for yourself, like, what is your insurable need? What do you need the insurance for? What's the purpose of it? And then, can you afford it? And if it sounds gimmicky, or, it seems to be the hot thing that everybody else is talking about, why is that? Like, if it sounds too good to be true, do watch out. And I would say oftentimes, like if there's a flag that you're not sure about, we're always happy. We actually have accountants and lawyers that reach out to us periodically and say, you know what, my client's being pitched on this. Do you mind taking a second look at it and seeing if this makes sense? there's no harm in doing that. And it's easier to do it before something's in place than after.
Yes, that is so true. Thank you very much, Angela. That's a ton of wisdom there. Okay, so with that, thank you. We'll catch you next time.
Thank you so much. It was a pleasure being here.
Thank you so much for listening to the Physician Empowerment Podcast. If you're ready to take those next steps in transforming your practice, finances, or personal well-being, then come and join us at physempowerment.ca, PHYS empowerment.ca, to learn more about how we can help. If today's episode resonated with you, I'd really appreciate it if you would share our podcast with a colleague or friend, and head over to Apple Podcasts to give us a 5-star rating and review. If you've got feedback, questions, or suggestions for future episode topics, we'd love to hear from you. If you want to join us and be interviewed and share some of your story, we'd absolutely love that as well. Please send me an email at kmilo@physempowerment.ca. Thank you again for listening.